In this video, we're going to go over how to do a full investment analysis of a real estate property. So let's get straight to it. So let's imagine that you made a real estate investment. The first thing you want to find out is how much was your initial investment. And as you see here, we see that we paid $36,950. So I want to take a moment to show you how I came up with this number. So I'm going to go over to my project cost tab, and this is basically a breakdown of the real estate property that I bought, or for example, the one that you bought. So let's say we paid a total of $75,000 for the purchase price of the property. It cost us $2,500 of closing costs and $2,200 of pre-rent holding costs. And this is basically to account for any possible vacancy that can occur from the time of the purchase to the time that you lease to a tenant. The next repair that we factored for was estimated repairs of $17,250. And this gives us a total project cost of $96,950. Okay, we put a 20% down payment of $15,000, and 80% we took out a loan from the bank of $60,000. And so our total cash needed, which is also our total initial investment, is $36,950. And the way that I got to this number was I subtracted the loan amount from the total project cost. And that gives us our initial investment of $36,950. Okay, now the next thing I want to find out is, what is my cash on cash return on investment? And that is this cell here. The way that you want to calculate this is you're simply going to divide your annual cash flow payments, which is $3,572, and divide that by your initial investment. And this will give you an idea of how much you're going to earn on your investment your first year. And you can see here it's a 9.67% return on your cash. Okay, so let's take a moment to figure out how to calculate your annual cash flow. So the first thing you want to do is you want to record your income revenue from your tenants, from the spaces that you're renting. So in this example, we are making $1,200 per income per tenant. And let's assume that we only have one tenant. The next step we want to do is we want to calculate our total expenses for the month. So you see here we're paying $322 for our mortgage payment. We're paying $122 in taxes, $56 in insurance, and then we've also calculated some amounts for vacancy, repairs, and capital expenditures. So it's important to budget for these three expenses here, because even though you may not have a vacant building, you want to make sure that you're setting money aside for future vacancy. Right? For example, you may have a fully occupied building this year, but next year your tenants may leave and now you have an empty building. So you want to make sure that you're saving up a certain amount of money each month to prepare for those situations. And the same goes for repairs and capital expenditures. So we have $60 for vacancy, $60 for repairs, and $150 for capital expenditures. And the last expense that we have is the property management fee. Because ideally, when you invest in real estate property, you eventually want to hire a property management company to manage your property for you. And they will charge you typically anywhere between 8% to 12% of your monthly revenue, as you see here. So if I take you over to my detailed schedule, you will see that I'm paying 11% in property management fees. And I'm also budgeting for 5% in repairs and 5% vacancy rate, which is how I got to this amount here. All right, so now that we've accounted for all of our expenses, we're simply going to add up our total expenses, and we get a total of $902. And to calculate your total cash flow, which is also your monthly net income, you're simply going to subtract your total expenses by your total income, and that gives you $297. If you multiply it by 12, we get to $3,572. So that's how you calculate your annual cash flow. Okay, so let's go back to our investment analysis. So now let's say that we are getting ready to sell the property and we want to figure out what is our total return on investment, also known as ROI. So we have held onto this property for 5 years, and if you see here on the right, I've created a table of my property throughout the 5 years where I held the property. And each year my property has increased 2% in value due to any demand in the area, or for example, property values just go up over time. So I've accounted a 2% appreciation value each year, and by year 5, my property is now worth $132,490. All right, so this is the price where I'm going to get ready to sell my property for. So the next thing I want to find out is how much is it going to cost me to sell the property. So I've accounted for $8,000 in commission fees that will have to be paid to the broker, and I've also calculated $4,000 for any additional closing costs, and I've also calculated $5,000 for any cleanup, such as giving the property a new paint job, and that gives me a total sales expense of $17,000. All right, so this is kind of a summary of our transaction. So again, we have a sell price of $132,490, which is the property value at year 5, end of year 5. And then we have a total sales expense of $17,000, which we just calculated. And now we want to factor in the amount of loan that we still need to pay off, the amount of money that we still owe to the bank. And this is called your loan payoff. So let's take a moment to figure out how we came up with the loan payoff. If you see here, my loan payoff is tied to my mortgage tab. So basically in my mortgage tab, I've created this amortization of a schedule that shows me how my loan has been paid off. And so when I initially took out a loan, I took out a loan of $60,000, and it was a 30-year fixed rate mortgage loan at a 5% interest rate. So as you can see here, the first month of the loan, my principal is $60,000. I pay $250 of interest, and $322 went to actually $72 of the mortgage payment went into the actual principal, which gives me an ending principal balance of $59,927. And you basically calculate that by subtracting the principal payment minus from the principal amounts, and you get a total of $59,000. So if I fast forward to 5 years later, you see that my loan balance amount is $5,500. And this is how I got to the loan balance. So we want to make sure we factor that into our transaction here. Our total capital invested, again, is the same as our initial investment. And now I'm basically just going to subtract the sell expense, loan payoff, and total capital invested from the sell price, which gives me $23,523. Okay, and the last and final step to calculate the return on investment is to figure out what is our accumulated cash flow. Our accumulated cash flow is basically our annual cash flow times the number of years that we've held to the property. So we know that we've held the property for 5 years, and we made an annual cash flow of $3,572. If we multiply those two together, we get $17,863. All right. Now, equity is the amount of a worth that you've built throughout the property, and the way that you can calculate this is simply how we calculated the same profit. So we're simply just going to subtract the sales loan and invested capital subtracted by the sell price, and that gives us the equity. So it's the same thing as you can see here. All right. If we add the accumulated cash flow plus our equity that we've built, we get a total of $41,398. So now we have everything we need to calculate our return on investment. And the way we're going to do that is we're simply going to divide 41,398 divided by our initial investment. And then we're also going to divide that formula. As you see here, I have double parentheses. I'm going to divide it by the number of years that I've held the property for, and that should give me 22.41% return on investment over a 5-year period. Okay, and so another way that you can calculate this to make it more detailed is there's an actual formula that you can calculate this. So the formula that you want to do is basically equals, and you can do this on a sheet of paper if you don't have Excel, but basically you want to go ahead and start with your sell price. You're going to subtract your selling expenses. You're going to subtract your loan payoff, and you're going to subtract your initial investment here. Then you want to go ahead and add any accumulated cash flow. And then you're going to divide that by your initial investment. Now remember, we are holding this property for 5 years. So we're going to add another parentheses, and we're going to divide that by the number of years that we held the property, which would be 5. And that should give us the same number that we get here. And for some reason, it's not giving me the answer. Let's see what I did wrong. E22 holding period. Oh, that's why. Okay, so this number will go at the end of the formula by dividing it by 5. And there you have it. That gets us 22.4% ROI. Same as this number. So I hope this video was helpful. If you have any questions, please feel free to leave me a comment down below. And if you like this video, subscribe to my YouTube channel, as I will be posting more videos on real estate topics and investment analysis. Thanks.